now. Julia, what a session.
Session, we saw a spike up in the market and on some very strong volumes, about $6.5 billion worth of stock being traded today. Part of what that was that we did see index expiry, but we also saw the market reaching the highest point that we've seen in around about 5 years. 5,300.1 was the highest mark today. We briefly touched it and then pulled back to finish at 5,295.5 points. So it does look like the psychological mark of 5,300 points is what the market's going to be watching over the next couple of sessions. And of course, if we manage to get over that hurdle, it's all about the 61.8% Fibonacci level of 5,426 points. I guess one of the things that we noticed on today's market is that we did see a big drop off in implied volatility. The Australian market has its own volatility index with the stock code XVI, and that was down by about 10%. So if we have a look at the Australian VIX index, this is what it looks like over the past year. And you can see we've seen a significant drop-off lately. Now that's actually a positive for the market because the Australian VIX index and the Australian benchmark index tend to have an inverse relationship. So as we see implied volatility falling, we see the market rising, and we certainly saw that relationship today. So technically looking pretty good. We did see some good volumes, and that also supports the move up as well. We have a look across the market though. Typical risk on day. This is something we've become quite familiar with, and that is the growth areas outperform, the small cap areas outperform. We saw the small ordinaries index up a massive 2.1% on markets. And in terms of the sector, the best performing sector was the material sector. That's not a surprise because during QE1 and QE2, this was one of the best performing areas of the market. The material sector up 29% during QE1 and up by 12% once QE2 started to be priced in from September, the year that it started. So altogether, a great day on the market, some good volumes, technically looking pretty good. We're looking for the psychological mark of 5,300 points near term and then 5,426 points as a resistance mark.
Does it continue, Julia? I mean, it's one of the questions that people are starting to ask now. Great jump today, options expiry, Ben Bernanke's decision not to taper, all coming together to give it a big boost today. But in regards to the Fed non-taper, is that going to be enough to sustain gains moving forward?
Well, we have another month where the Federal Reserve will be pumping $85 billion into the US economy. So that's going to support risk assets. And of course, the market had been winding back its expectations around tapering. It had high expectations around tapering, in fact, phasing out all quantitative easing by the end of 2014. So those expectations have really been blown out of the water. So in the short term, it does look like the risk is to the upside for risk assets, especially for gold. I mean, it's been an absolutely amazing run for gold over the last 24 hours. We have a look at gold prices. We saw them jumping by 70 US an ounce. We haven't seen this type of move since January 2009, the beginning of the global financial crisis. And of course, the gold subsector on the market, phenomenal today, up by a massive 8.9%. In fact, 4 of those gold stocks in that gold subsector, that's Saracen, Perseus, Doré Minerals, as well as St. Barbara Mines, all managing to gain more than 20% in just one single session. So those leveraged plays on gold absolutely having an amazing day. We have a look at gold technically as well. It's coming up to some interesting points. This is gold over the last 3 years, and you won't be able to see the 3 moving averages very well, but we're very close to both the 50 as well as the 100-day moving average. So in terms of technicals for gold, watching 1340 and 1350 US an ounce, and of course, if those hurdles are cleared in the short term, we'd be looking for that 200-day moving average line, which is just under 1500 US an ounce. So I think the risk is to the upside for risk assets, especially for gold. So short term, the momentum is going to be a positive one.
Hey Julia, it's Martin here. I'm just interested particularly on the gold side, although I think it's probably the same for the broad market. It does seem to me that the market was factoring in tapering, and traders were going into last night probably neutral, if not a slightly short. So maybe part of today's reaction, particularly in the US, the gold price, and to some extent our market, is short covering. Would you agree with that?
Absolutely. We would see some short covering. Usually when you do see moves of 20% plus without any announcements coming through the market, you do expect to see short covering. And one area where we have seen massive short covering is in the US Treasury market. There had been an almost record build of short positions in terms of Treasuries. And of course, we're going to be seeing a massive unwinding of that in the coming weeks. So expecting to see those longer term yields in the US coming back down again. And I guess that's one of the things that the Federal Reserve wanted to do, because we have seen the longer end of the curve seeing interest rates rising upwards, and that would have been a big headwind for the US economy. So I guess in terms of this no taper announcement, the reason why it's so important is because it sends a signal to the market. It sends a signal to the market that the Federal Reserve, it had the perfect opportunity to taper and it didn't. It's probably going to lay off tapering for a while. Not only that, we saw the Federal Reserve coming out to downgrade its growth expectations around the US. So GDP growth was also downgraded down to 2.3% growth in 2013. That's down 0.3%. Previously, they were forecasting 2.3 to 2.6%. So they've downgraded their expectations for growth. They've also downgraded their expectations in terms of PCE inflation. So altogether, it does look like the Federal Reserve having a weaker outlook in terms of the US economy, and so sending a signal to the market that they're in absolutely no hurry to taper anytime soon.
And Julie, with this rally in Treasuries and hence some lower yields, and that obviously taking some pressure off the US dollar, obviously we've seen our own Aussie dollar rally very, very strongly. Does this increase the likelihood of further rate cuts here in Australia? I mean, Macquarie's view, which is 2% cash rates before the end of the year, currently 2.5%. But do you have the same view now?
Absolutely. So it looks like we will see another rate cut before the end of the year, and the market's really starting to price that in, as well as the Aussie dollar. What we have seen is weakness in the US currency, and we know the Reserve Bank wants to see the Australian dollar lower, but of course today we've seen it trading above 95 US cents. So that's really increasing the pressure on the Reserve Bank of Australia to cut interest rates further at a time when we know that there is a pullback in terms of capital expenditure in that mining space, which is quite a big part of our GDP. So watching the RBA very closely, interest rate expectations for a cut are rising into this. And the other stock to really be watching in regards to this is QB Insurance. We know that it has a big portfolio of US bonds and US Treasuries, and of course as yields fall, then their investment returns from that portfolio also falls as well. So QB Insurance coming under a fair bit of pressure today, and you can see that one as a barometer for the currency, the US economy, as well as the US Treasury market.